This is a CBSN Pittsburgh special presentation.
Hi, I'm Jon Delano, money editor, KDKA Television, CBS Pittsburgh. And our very special guest today is Christopher Cuddy, who is a certified public accountant who advises lots of folks when it comes to taxes. Chris, thank you, sir, very much for being with us today. I really appreciate it.
Thank you, John.
So let me ask you really the basic question. Is it too late to do things that could help you with your 2021 tax return?
No, it is not too late, John. We still have a couple days left, and there are a couple things that people can do to reduce their tax burden for 2021.
Do a lot of people ask you this question at the end of the year? Is this a common thought that once Christmas has passed, people start thinking about this?
Absolutely, John. I've got a couple emails already asking me about whether they should do this or do that to reduce their tax burden.
So let's talk about some of the things that people can do. Chris, what do you think is for the average family out there, maybe both husband and wife are making an income, pretty much middle income families, are there things they can do now that would be helpful?
There are a couple things that they need to consider. It really depends upon where their tax situation is. They can, some people had a very good year, and they may want to consider deferring their bonuses before year end to avoid the tax ramifications for 2021. However, you need to run the numbers because next year's taxes may be going up. We do not know. I mean, there's various proposals in the Congress that maybe possibly next year's tax rates will be higher. So you really have to run the numbers.
Yeah, deferring bonuses. I mean, the whole idea is to reduce your income for this year by putting off a payment of income to you until next year. Do companies do that? I mean, if you're entitled to a bonus, will they work with you on that?
Well, most companies, John, are on the calendar year basis. So they try to get these bonuses paid by year end. Most employees do not have the option to pick up to take the bonus next year because of course the company gets the write-off during 2021 if it's paid in 2021. However, some companies do offer that option.
Let me ask you about another possible way to improve your tax situation. I understand that if you make your January mortgage payment in December, you may be able to deduct the interest on that mortgage payment. Is that true?
That is true, John. If you can make your payment on your mortgage, and let's say the mortgage payment is due on January 2nd, 3rd, 4th, or 5th, you should be able to pick up additional mortgage interest expense on your return for those days before that payment hits the bank.
So if you're willing to make that extra payment or make a payment in December, you get the January payment in December, you get that benefit.
Yes, you do.
Are there other kinds of deductions that you can sort of accelerate?
Yes, John. Most people that I've noticed are not itemizing their deductions because of the limitations that the IRS have put on due to the state and local income tax deduction and other things. But most young people who are early in their mortgages are able to itemize their deductions. As such, they should be able to deduct all of their charitable contributions. However, since 90% of the people in this country cannot itemize their deductions, they need to look into picking up and it's just a small amount. You can pick up a $600 cash contribution to a qualified 501c organization and write that off in addition to the standard deduction that they get because they are not itemizing.
Yes, I know that gets a little complicated for people, but this is under the CARES Act.
Correct.
The CARES Act basically allows an individual to make up to a $300 deduction, even if they didn't itemize, $600 for a married couple. Is that? I mean, that helps a little bit. It's not a lot of money, is it?
It does not help a lot, right? But if you can't itemize your deductions, you've got you're later in your mortgage. You do not have that much mortgage interest, and you don't have that much other charitable deductions. Sometimes it's best just to pick that up.
And I assume that also applies for your taxes, that if you have taxes that are due, for example, school district taxes, which oftentimes allow you to make those payments into January and February, if you make them after December 31st, you won't be able to deduct them on this year's taxes. So you really need to make sure you pay all your taxes as soon as possible, if possible, right?
That's correct. If you have a bill that's dated in January, and if you pay that bill by December on a property tax or or even your state and local income taxes, if you're paying estimated payments, those would be eligible to be deducted in the 2021 tax year.
Gotcha. What about those who are near retirement? Is there something they can do in terms of contributions to their 401ks, or maybe it applies to anybody? I mean, what are the rules with respect to that if you're trying to really minimize your taxes for 2021?
Well, you'd have to look at really where they're at in their life. If they're an older person, there are various parameters that they have to go through as to whether or not they can pick up an IRA deduction. But a great way to reduce your taxable income is to contribute to a 401k or a traditional IRA. If you're self-employed, you can contribute to your SEP IRA and contribute up to the lesser of 25% of your net self-employment income, or $58,000. Now, with the Secure Act or the CARES Act, they have until the due date of the return. Most businesses have till the due date of the return to make that payment. So they can pick up a deduction in 2021 as long as they pay that by the due date of the return, including extensions.
So that may be something you don't have to do this week. You could wait until April 15 of 2022.
Correct. And in the old days, the only retirement plan a business could set up was a SEP. And they did not have to even have the documents signed. They could set the SEP up in 2021, or I'm sorry, in 2022, and pick up the deduction in 2021. However, there were changes in the CARES Act that are also allowing for other retirement plans that can be instituted, and you can pick up the deduction in the prior year.
Sounds like it's good advice to talk to your tax,
Yes.
accountant.
You have to. It's just there's so many changes this year. I just attended two 8-hour seminars, and the booklet was 1,100 pages long just on the changes in the tax law.
Wow. Chris, what about this opportunity? If you have certain education expenses, tuition expenses for classes or career improvement sessions, can you advance pay on those as well?
Yes, if you have let's say you have a child in college or you're taking a class yourself at a qualified educational institution, as long as you make that payment by December 31st, there is a credit that's still available on your tax return that can be picked up.
Well, that's helpful. It's not for the total expense. If I'm reading this correctly, it's a $2,000 per tax return credit. Is that about right?
Yes, that's correct. You can pick up a credit for the expenses that you paid for your child for tuition and books and fees and things like that can be deducted in your 2021 tax return as long as you paid it by the end of the year.
Gotcha. Anything else that you might be thinking of in terms of advising the average working folks out there who are looking for ways to save on their taxes?
Well, the one thing they might want to look at, the market's been up so far. It was overall pretty far. It did pretty well in 2021. but sometimes you have losses on your investments. So you need to look at your unrealized losses on your brokerage statement, and you could possibly take those losses in 2021 and offset some of those gains. If your losses exceed $3,000, you get to pick up a $3,000 deduction on your tax return, and the remaining amount will be carried forward to the next year.
Gotcha. Of course, that's only for those who are investing in the stock market, and it would not apply to your 401ks. Most people who are in the stock market are in their 401ks or IRAs. They're just pumping money in with every paycheck, right? That's
correct. The 401k gains and losses that you incur on your 401k are not reported on your tax return. The only monies that you have to worry about with a 401k is whenever you start pulling money out of that 401k in your retirement years.
Right. I still can't get over the fact that you said you had a booklet of 1,100 pages.
I know. It's just incredible, John. Every year we attend these seminars, and just to keep up, it's just you just have to really study it and see what applies.
Well, all the more reason for folks to be in touch with their tax preparers and others, because it's never easy to do this on your own. I know, because I've tried. Our very special guest is Professor Carol Macphail from Robert Morris University. Professor, thank you so much for spending time with us. I really appreciate it.
My pleasure, John.
You have an incredible history, having spent many years in the private sector before joining Robert Morris 10 years ago. Maybe you could tell our viewers exactly what your background is.
Would love to. So I'm a Pittsburgh native, like many people, but I joined Deloitte, which was Deloitte Haskins and Sells back in the day. And I spent 35 years with the firm as a tax partner.
Wonderful. And now you've been teaching students at Robert Morris?
And loving it. They say some of us flunk retirement. I definitely have, but I've really enjoyed the time I spend at the university.
Well, thank you so much for joining us today, because I wanted to ask about lowering your taxes in 2021 when you only have a few days to go. Is it too late to take some action to reduce your personal income tax this year?
It's absolutely not too late to take some action. And I know, John, you said reducing your taxes, but whether you want to reduce this year's taxes or next year's taxes, really the next week is an opportune time to do that.
Are there some key things that you keep in mind when you get asked this question, which I'm sure you do at the year end?
Yeah, always at a lot of Christmas parties, right? But the key thing people need to, before they take any steps, is they have to know what tax bracket they're in, both in the current year and the bracket that they would expect to be in next year. So to me, that is question number one. You know, if you don't know where you're going, any road will get you there. And this is the first question that people have to have an answer to.
So if your taxes are going down, paraphrase this, if your income is going down next year, or your tax rate is going down next year, you might be better off really putting things off until next year and not trying to rush something into 2021. I don't know if I stated that right.
No, so we could look at it this way. If you are in a higher tax bracket this year, in 2021, you would want to accelerate deductions. And I say accelerate deductions, you could decrease income or accelerate deductions, but most of us can't decrease our income, right? Most people are paid wages, and what's coming in, Social Security, pensions, what's coming in is coming in. So if you're in a higher bracket this year, you might want to accelerate a deduction into 2021. Consequently, if you are in a lower bracket this year, you might want to accelerate income. And I've got a few ideas for your viewers on how they might do that too.
Okay. Well, that's great.
We can talk about both sides of this.
Yeah. All right. Well, let's talk about the income side. One thought I've heard is if you can get your employer to put off giving you a bonus, your 2021 bonus until January, I suppose that puts off income for a year. I don't know that many employers do that, but I guess that's a possibility.
Well, certainly large companies have a very fixed schedule, usually around bonus payments. So that's a little bit hard to arrange. But other moves that a person could take, for example, if they wanted to accelerate income, they might be able to convert a traditional 401k account or a traditional IRA account to a Roth. That actually causes an income event. So if you were in a lower bracket in 2021, you might want to increase your income. And one way to do that would be a Roth conversion of your 401k or your IRA. Similarly, if you anticipate being in a higher bracket next year, you have a limited amount that you can put away for your retirement, you may want to push off some of your, for example, an IRA contribution, not making one for 21, but making one for 22. And you do that by making a designation when you make the contribution.
Yeah, now this gets a little bit complicated. And
yeah, it does. That's why we have a job.
That's right. You need tax expertise. Let me come back to something that seems a little perhaps more simple.
Okay.
And that is the charitable tax deduction. Because the CARES Act, even if you don't, itemize, and fewer people itemize, the CARES Act does allow, I believe it's $300 per person in charitable deductions. Is that right?
That's correct. This is a very unique opportunity. So for 2021, the tax code was amended to allow up to $300 per taxpayer per filer. So on a single return, $300 as a deduction for adjusted gross income, even if you don't itemize. And on a joint return, that would be $600 for both filers, even if you do not itemize. And this is a one-shot deal. So far, it is not going to repeat. Of course, who knows what they're doing in Washington, but.
No, I think that's right. We have no clue what's going to come out of this Congress. But bottom line is that if you give a donation to any 501c3, any tax deductible organization, you're going to be able to take advantage of that in 2021 and maybe not in 2022.
Right. And that could be done by check. Okay. Date of mailing is considered the date of the contribution, but it can also be done by credit card. And I'm one of those people that frequently procrastinates. And do you know what I'm doing on New Year's Eve afternoon? I'm sitting in front of my laptop with my credit card, making charitable contributions many times, and people can do that. Date of transaction brings it into 2021.
And that's really a key point, because then you're not actually paying off the credit card until 2022.
Correct. Correct.
So you've actually made the deduction in 2021, but you haven't paid for the deduction until the next year.
Yes, that's correct.
I think that's pretty cool, actually. I've heard about that credit card routine. I haven't used that. I generally write a check, but if I wanted to, I could make a tax deduction, charitable deduction on December 31st and not pay for it until next 6 months from now. Who knows?
Correct.
So,
except that it's always a good idea to pay your credit cards off every month.
Well, that goes
unless
to
you've got a great rate.
Right, that goes to another rule. So what about the idea of prepaying your mortgage with interest, your January payment that's due January 1? What about making that payment on December 31st?
1 month will generally work. So a 1 month prepayment would generally be deductible in the prior year. The challenge is with the increase in the standard deduction, many people, even with larger mortgages, are no longer itemizing. So before one of your viewers would do that, I'd say make sure you know if you're itemizing or taking the standard deduction.
Yes, because it doesn't really help you if you're taking the standard deduction, right?
Correct. And that's the unique thing about the charitable contribution that you suggested, John, the $300 and the $600. That works for everyone, whether you itemize or not.
Yes, exactly. Exactly. Are there other things that you could do that might be helpful to your tax return in 2021?
Well, let's maybe talk about investments. So if viewers have investments in a taxable account, maybe they own stocks or bonds, fixed income securities, that can take us in both directions, whether you want to accelerate income or get a deduction. So for example, one of the frequent advices out there is tax loss harvesting. If you have a security that has gone down in value and perhaps you're not so enamored with it anymore, it can be sold at a loss, and up to $3,000 of a net capital loss can be used against other types of income, like your wages, like your pension, like Social Security. So that's creating a deduction. But if you were that person who's in a low bracket this year, right, and you're going to be in a higher bracket next year, you might want to accelerate income, and you might take a look at the market and say, wow, it's pretty high valued here. Maybe I should sell and not take my money and run, but at least cash in.
Yeah. Yeah. Again, now that doesn't apply. That really only applies to people who invest in stocks. And
Correct.
most of us invest in stocks through our 401ks and our IRAs. We don't have really separate accounts. So for those folks, is there anything they should be aware of if you have a 401k with your employer, for example, or an IRA? Anything you should do right now?
Yeah. Well, at this point, it's a little hard to modify your 401k, okay, to put more money in. As I had mentioned before, many companies have 401k plans that allow you to convert a traditional account that went in pre-tax to a Roth, and that would create income if you're lower in 2021 compared to 2022. With an IRA, however, you have until April 15th to make your contribution, be it tax deductible, pre-tax contribution, or Roth. And it's always an important date because many people, and I'm sure your viewers too, know that you can extend the filing date on your tax return for 6 months. You cannot extend the date that you have to make your IRA contribution. That's April 15th.
Right. And the good news there is that December 31 is not the deadline. You actually get an additional a few months to
3.5 months.
Yeah,
correct.
Right, exactly.
3.5 months.
Anything else, Carol, that you can think of that we should be aware of when it comes to our taxes at year end?
Well, I think, it's always good to take stock of things at the end of the year, for example. So, for example, spending down, many healthcare has changed a great deal. I'm sure all of us would agree about that, right? And people have health savings accounts. They have flexible spending accounts. With a flexible spending account for healthcare or childcare, it has to be spent down by the end of the year. And so you might see some of the ads from many of the, I guess I really can't mention names of retailers and things like that, but they're saying, hey, come in and spend your FSA dollars. So whether that be on prescriptions or other things that would apply, that would be a good thing. Maybe an extra pair of glasses. Maybe you always wanted the prescription sunglasses. I know I treated myself a couple years ago for that very same reason. It's also a good time to take stock of what will your W-2 look like next year? And maybe this is a time to adjust your withholding. Some people never have enough taken out. Other people lend money to the government for free and have too much taken out. So this might be a time to look at your tax withholding and get it right.
Well, Professor Carol Macphail from Robert Morris University, this has been a great conversation. Thank you so much for sharing your expertise with us. We really do appreciate it.
Thanks, John. Have a good day.
This has been a CBSN Pittsburgh special presentation. We now return to our scheduled programming in progress.